sustainable development is a very big word, but it's absolutely not that expensive. It's absolutely possible, and it can absolutely be transparently communicated to the market, both the investing, the general public and the investing market.
If you can mine and process using as much renewable energy as possible and as many green processes as possible, so you're demonstrating that there's a cause and effect, everything is connected. The materials that you're mining are the ones that will enable, and it kind of keeps going in an iterative process back and forth.
My view is we're in a decade now of deglobalization and reindustrialization of America in particular, but also the West in general. And so you will see different forms of financing emerge, which are not necessarily market linked, in order to build mines in Utah and Colorado and these places.
Hello, everyone, and I'd like to welcome you all to another Assay Live content session for the one-to-one Global Online Tech Metals event. So today, to talk about investing in the energy transition, we have Aris Eikelov, Managing Director of Traxys, Anthony Milewski, Chairman of Nickel 28, and Amanda Van Dyke, Managing Director of Arch EM. So I'd like to thank everyone for being with us here today.
Thanks a lot for having us, Amy.
Absolutely. And so just as a bit of an intro, in 2021, the COP26 meeting saw a lot of countries committing to further accelerating their decarbonization plans, strengthening emissions reduction targets ahead of the timeline set out in the Paris Agreement. With the accelerated phase out of coal, there is a growing target for the mining industry to grow the supply of the key, battery metals that are going to help the batteries and the renewable energy space. And so analysts have noted that there is a significant amount of metals are needed for the energy transition to happen and for the EV and renewable energy industries to flourish. So I guess to kick things off, what are you seeing most? Where are you seeing most of the investment into the industry going? So I don't know if you want to talk about different commodities, regions, anything specific. Where is the investment going right now?
Amy, I would be happy to answer that first question. I think that's actually really a political question in a way, because from my perspective, what we see is a wholesale lack of capital from the West, and we see tremendous investment coming out of China. And it's a really interesting moment, because as you kind of alluded to in your question, we could talk about copper and the need for copper. We could talk about the need for nickel or cobalt or lithium, and it would all be true. But in terms of people writing checks and cost of capital, China is the lowest cost of capital by and large. And so very little, if any, financing has come out of, say, the US government or the Canadian government to develop their domestic mines. And so just as a general starting point, I think it's a little bit of a political question in the sense that countries like China have committed to investing and allocating the capital to build these next generation of assets in Africa and globally. And they already, by and large, control them. And I don't see that changing anytime soon, especially now with the slowdown in the global economy and a kind of a wholesale unwillingness to deploy capital into our space. And so it's kind of an interesting question in terms of where we're at in the cycle for deployment of capital in the space and where we are going to be for the coming foreseeable future, at least from my perspective.
Maybe I'll jump in on the second round there. I agree with, look, China's been preparing for the energy transition for 20 years, and they have sophisticated investors and a sophisticated system of investment into the natural resources space. They've been scouring the globe, and the government supports their large companies to go and sort of buy up as many of those assets that are going to support their huge manufacturing base. And they're very good at it, and they're frankly better at it than we are. And I mean, the best way to see that is lithium. They've gone all over the world snapping up all of the lithium assets they can get their hands on. That being said, and I also think that Anthony's also correct in saying that the West has made all of these huge commitments to net zero, theoretically using existing or present technology, which may or may not be the case. And they say they're supportive of investment in the global mining sector, but that isn't seen. Like, we really haven't seen the flows to the sector that would show that they're putting their money where their mouth is. And I think a lot of that is because there's a real disconnect in the public sphere in terms of understanding that if you want electric vehicles and you want renewable power and turbines and, you know, solar panels, as well as the grids that run them, you need many multiples of the amount of metal. That understanding that the transition off of fossil fuels essentially means the transition onto metals. I'm not sure that that's a well understood thematic anywhere other than, like, properly well understood anywhere other than China. And therefore they're dominant.
But also, man, I think because this is so interesting is, it's not that it's it's in China, it's the government allocating the capital. It may be vis-a-vis a state-owned company, but in the West, you have the market allocating the capital. And until about 6 or 8 months ago, like, why would you, by and large, why would you even look at our space when you could go invest in tech, have liquidity, as much liquidity as you wanted, and make a lot more money? And so it's actually just not been attractive to a generalist investor who doesn't understand the space. And, you know, a shift after the 08-09 crisis in terms of how hedge funds are allowed to invest with liquidity and you know, the requirement to be able to sell their position in 3 days. And so, you know, there's this private public issue as well, which is in China, it's all public funds, taxpayer dollars effectively buying these assets, where in the West, you're relying on the market. And it's just frankly not been interesting to most investors to invest in our space.
Yeah, just to complete what you're saying, we were joking that the invisible arm is really invisible as we were thinking about how to put together, you know, what we call the pan-Atlantic supply chain. It's kind of a phrase we coined a few years ago, sort of assuming that almost naturally, where there's a hole, hole without a W, and there's a vacuum and there's a need. That's where investments will go. That's where the gap will be filled. And it turns out that it's not that obvious as as we thought. Although with the Inflation Reduction Act, there is perhaps maybe a bit of a new direction here, and some understanding that cheaper sources of funding need to be allocated to the private sector in order for it to really step in and move things forward. And there is a bit of a paradox here. If you look at the supply chain, kind of upstream, midstream to downstream, usually, under the theory of constraints, you'd expect the constraint to be in the link in the chain that's most capital intense, that's most technology intense, etc. But at least on, in our part of the world, everyone's happy to announce gigafactories galore. But when you actually go backwards and try to figure out where are these materials going to come from, then it takes 15 years to get a mine licensed, if you ever can do it. And there's a huge trust issue between the extractive industries and the general public, especially the younger generation, which is something that we need to work on. And I guess we'll address it later in the panel, because I think there are some solutions, but it's a marathon. It's not a dash.
Yeah, I do think I agree with all of that, but I also think things are slowly changing. I mean, there's an inherent, you just need to look at one of those massive wind turbines and see that their entire thing is constructed out of metal. So when you kind of bring that to people's attention, they get it. And the Inflation Reduction Act, the new UK critical minerals legislation, the European critical minerals legislation, there's a whole lot of slowly, look, the government has slowly figured it out. Like, oh my goodness, there is such a thing as critical minerals, and the energy transition is not possible without it. They have kind of passed the ball. It's been a very bad pass, and we'll let private investors deal with it. That won't work forever.
No.
But nonetheless, I do think that a little late to the party, but they are starting to get it.
I agree.
But still, if you're a pod of Millennium, it doesn't matter. You could own Cameco or Freeport or BHP, but it's pretty darn hard for you to own a $300 million microcap. And the cycle for these things tends to be, a couple people put together 20 million bucks, and then it goes to 150, and then on its way to a billion. That cycle. And I think that's, if we're talking about being funded through the Western capital markets, we're really talking about that cycle, which it was materially altered after the 08-09 financial crisis, when hedge funds restructured and really have an aversion towards illiquid semi-private investments. And so even if people like it, that fund flows really goes into liquid gold and base metal names. But if we're talking about this earlier stage stuff, the only thing which has changed in the last kind of 10 years that I could see is the rise of the Orions of the world that are basically smashing these companies in with streams, royalties, structured debt. But if you want to talk about the equity, the 5, 10, 15, $25 million checks, the private equity firms that have arisen in the last decade, they're not writing those checks by and large. And so while people can sit around and talk about it, and in DC or in London or wherever, the actual capital markets themselves haven't decided that it's sufficiently urgent enough for them to come in mass like they did. Like, there's no RAB capital of this cycle. Remember RAB capital last cycle, $6 billion, they'd write a check in anything. Like, that doesn't exist yet. And you really need that risk venture style funding if we're going to continue to utilize the Toronto, Canadian, Australian capital markets in the way that historically has operated.
Yeah, you are seeing it a bit more on exploration now, I think, if at least we're seeing that in Canada and the US. We are seeing sort of at least funded for the next drilling campaign, quite a few explorers in lithium and in nickel. So maybe at least on sort of grassroots and enthusiastic type of, I guess, more angel investors than anything else, or early stage investors. There's a bit going on there, but definitely, when with the royalty and the streams and the debt funds becoming the flavor of the day, pure private equity as an equity, is just, there's just not enough there. We tried, as you know, in Traxys and Pallinghurst Traxys to get a few of those going. So we invested in the Nemaska Lithium and Nuvamon Graphite and Tala Nickel and Li-Cycle for recycling. But you need 100 of those type of investments, and you actually probably need funds of funds and not just the typical institutional investors to log in as LPs. It's just not enough.
It's a structural thing though. Like, there's only so much money in the pie, and these structured royalty funds have sucked all that money out of the system. And so, Amanda, you might know this better than I do these days, but if you want to go raise $200 million for a long short commodities metals fund, it's going to be exceptionally hard to do. Like, all your investors have been now trained for the last decade to buy a structured fund. And we're kind of dwelling on this, but I think it's materially important because this, beyond retail, this is really the source of funds for the space, and retail can only carry these stories so far. And you'll have these stories that Ross Beatty or someone sponsors, they can raise more money. But if we're talking about the average story, I think it's really challenging out there. And even though we're facing a cliff in some of these metals, I'm not sure the market cares.
If I can sort of jump in, I think you're both right, but I do think I think this is an evolution and the market is changing. Our fund was specifically set up to write those checks. And part of our issues, and we have found that there's a pool of capital, but it's a pool of capital. So like the big Western private capital comes from pension funds, endowment funds. That's where all this money is coming from. That's who private equity funds go to. But they've always had an issue with the fact that the private equity was set up to go after private companies and junior mining companies, or companies that in any other industry would still be private and take that long-term patient capital from private equity funds, are actually public. And I think that there's and because of that, private equity style investing in the junior public markets, which is the only way to really invest in mining, in development stage mining, it's been hard to get, and they've had trouble performing because, private equity funds initially went out there and they took like 30, 40, 50% stakes in a public company and then wondered why it didn't perform. I think that the providers of capital and the private equity funds have to find different ways to put patient development, private equity style capital into these junior public companies. And I think that is happening. We're finding success.
Also, Amanda, like the other part about private equity is, one, historically it's leveraged, and you would be crazy to leverage up an investment that's not going to produce for 8 years. And then the other thing is the way private equity works for the audience is, it's this mark-to-market return profile. And when it's private, they can kind of mark it within a range. There's a level 1, 2, 3 marking process, at least if it's a U.S. registered fund. But if it's, if it's publicly traded, you're marked at the market. And let's be clear, these things can trade up, to $1 down to a nickel on $50,000 of volume. And that creates a huge performance looking issue for these companies, because then they can no longer market privately. They have to market at the public mark. And if you're a private equity fund, like, it's just not tolerable, because the LPs for a private equity fund are fundamentally different than for a hedge fund. They're two different set of investors. And as Amanda said, it doesn't work. And that's why, by the way, historically, all these things are public in Canada and Australia, is because of liquidity and funding it through people who want to be liquid. And so I think it's all a 20-minute way of saying that, it's a paradox that I don't think the market's solved yet.
I don't think junior mining belongs in a hedge fund, period. That's not the right place for it. But because it's public, it's had trouble within private equity. I think what you need is if you're going to fund these things, you do need private equity style investing, whether that comes from a private equity fund or anything else. But it is a hybrid model. We run a hybrid model, and we've had to do a ton of investor education to say, we're not a hedge fund and we're a private equity style investor, but we invest in public markets. And it has been hard. I don't argue that at all. But once you sit down and explain it properly, I think there is a huge market there. If you're willing to be a patient investor in equity and get through the development, I don't think private equity style or even hedge funds are there for pure exploration. But in the development stage, I do think that there's a really solid economic argument for private equity style investing in these, and patient investing in these funds, in these companies. It's just about investor education. It's about getting a market that doesn't quite understand it to figure it out. And it takes longer to raise the money and deploy the capital, but nonetheless, we won't be the last. Orion is successful. It found a niche, and others will be successful as well.
Yeah. I think it's interesting. You bring up kind of the understanding of the industry. We've also talked a little bit about the trust issue of the industry, the PR of, getting maybe generalists to understand what the mining industry is all about, and the, I suppose, the impact that metals will have to drive the energy transition. How do we combat this trust issue, this PR thing?
That's a big
I'll jump
question.
in first. That's definitely a big question. There's not one answer. Of course, it has to do with transparency. It has to do with educating the public. It has to, do with explaining to anyone from Gen Z, millennials to the previous generations that these materials come from somewhere. It's usually a hole in the ground, whether it's open or deep underground. Contrary to what people think, there's not enough recycled material or stuff out there to just reprocess it and produce everything we need. If you want to have open heart surgery, then you need tungsten in your knife and so on and so forth. And if you want your cell phone to work or your battery in the car to work, then you need those materials. And it's again, it's a long process of educating, but there's a lot that we can do. And I think one of the things is that I like to think as, that could help here in terms of kind of long-term creation of trust is as much as possible, integrate between the products and and let's take renewable energy as an example. If you can mine and process using as much renewable energy as possible and as many green processes as possible, so you're demonstrating that there's a cause and effect, everything is connected. The materials that you're mining are the ones that will enable, and it kind of keeps going in an iterative process back and forth. So just again, an example with one of the companies we invested in is Nouveau Monde Graphite. So they were the first to adopt. They're in Quebec, so there's hydropower there. They didn't need to build their own solar plant or anything like that. So it's a privilege from that perspective. You get your allocation, but they chose electric yellow equipment when diesel was still cheaper. But it was a statement that they made that they're going to use electric yellow equipment. And then when the time came to choose the purification methodology, they intentionally chose the thermal purification as opposed to hydrofluoric chemical purification, which is dirty and dangerous. And again, you can do it because you can use an energy intense process if you're using renewable energy. And they took it even one step forward. The vapor that sort of cleans the tiny micron size graphite particles, the vapor is enhanced with a little bit of chlorine, which helps pull out the impurities quicker. So they intentionally build the plant next door to the chemical provider. So Olin, which is a big chemical company that has a factory in Bécancour, which is the industrial zone where the plant will be, is the next door neighbor of Nouveau Monde's value-added plant. And as they build it, basically they'll pull chlorine and give back the chlorine plus the impurities, which then becomes a product. There's a bit of iron in it, and there's iron chlorine, which is used for a chemical application. So there's a symbiosis with the provider of the material. There's a choice to choose the greener way of purification, and there's a choice to use electric yellow equipment. And on top of that, there's of course all the other aspects, the social aspects of dealing with the communities and creating a sort of a park and bike routes and things like that around the mine. So as you plan it, you're already thinking about the rehabilitation. So this is an example, and I'm sure there's more of a holistic approach that from the beginning, from the planning stage, makes choices that are just that are greener, that are more sort of communal and social. And if you look at the sometimes the OPEX of a specific item, if you really take into account all the externalities, is a little bit misleading. All in all, it's cheaper to be safe, green, and to live in harmony with your community. So that's one thing we can do on sort of, let's call it the primary production in the green fields. Another thing that I think would help is if we did a lot more rehabilitation and sort of reprocessing tailings and dumps and dams type of projects. Primary processing wasn't very efficient at the time. We have a lot of mountains and hills and ponds that contain a lot of the materials that at the time were rejected because they were not the primary things that people were looking for. A lot of the tin mines have lithium in the tailings, and there's a lot of other examples. Of course, copper mines have cobalt in them. So one of the things I think that we could do is across the industry and across the private equity as well is try to focus as much as possible on these type of projects, because you're creating a visible, meaningful rehabilitation that hopefully is also economical. And that's where the governments can help. I would probably throw in accelerated depreciation on any capital investment that goes in that direction, and tax holidays until you sort of returned your investment. And I think all in all, that's another example of something that in the long run can help people understand and accept that we're going to need to mine a lot more metals in the next decades, and probably forever, because no recycling is 100% efficient, and population isn't stagnant, and tastes and flavors and applications are not. So you cannot just assume that you reach some point where, it's like in some science fiction book, everything will be in some equilibrium, everything will be 100% recycled, and we won't need to mine anything forever. So we need to build trust and educate the public and harmonize with all the layers, whether it's the remote communities or it's the Z-Gen in college.
I echo exactly what Erez is saying. There, you can, especially if you're at the development stage, at the stage most of these junior miners are at, you can. We do it. So we put in environmental and social action plans that are optimized for every investment that we make. And much like Erez is saying, we found that if you build it properly to begin with a sustainable slant, it's actually not a lot. It's hard. It's the incremental extra cost for building it in a more sustainable way, for using renewable power, for taking alternatives to chemicals, for a better social license to operate, which is truly essential, and then applying transparency to all of that. The sustainable development is a very big word, but it's absolutely not that expensive. It's absolutely possible, and it can absolutely be transparently communicated to the market, both the investing, the general public and the investing market. I think the problem is it hasn't been done well in the past. And there's a lack of trust. There's a real perception out there that mining is dirty, in large part due to some big high-profile mistakes and often artisanal type mining, and often unfair, because the truth is the majority of miners I know and that I've known for the majority of my career do things really well. And I'm not saying mistakes don't happen, but I personally don't know anyone that's tried to make a mistake, done something the dirty way on purpose. Mm-hmm. I think that there is a way to do it properly, and it's a show me story, and showing investors with a lot more transparency that this is what it takes to mine, sustainably, and that it can be done, and that doesn't actually cost the earth. Occasionally, it's cheaper, to be honest.
Yeah.
And just to complete that thought, just one thing, Amy, is that this is also one of the causes of the delays, of the long time it takes from discovery to commissioning of an upstream. A lot of it has to do with trust. We're being asked for much longer baselines than you really need, because there's always a suspicion that maybe you haven't monitored it correctly. Let's do it for another year, for another 6 months. Provide additional, information. There's a whole, it's a little bit like, when letters of credit were invented, because people, at some point they kept sending merchandise to the other side of the world and they never got paid. So you needed sort of an honest broker to manage things. We still don't really have that here. So the onus just keeps growing and growing on the entrepreneurs, on the companies, to prove that they're okay, that they're doing things properly. But it's reached a point where a lot of it has to do with lack of trust. Do the reports again, add this, add that. A lot of it is because of a lack of trust, not because of real need. And again, I'm all in favor of doing it 100% properly. And if there are things that need to be monitored, engaged, do it for as long as it takes. But sometimes you see that these are kind of extra layers of extra caution that have to do, in essence, with a lack of trust. So you're just adding layers and layers and layers of unnecessary, sometimes bureaucracy and reporting duties that could have been avoided if the assumption wasn't that there's something wrong. Now prove that it's okay. If it was sort of a more neutral kind of environment and you were not working against the grain. So again, the onus is on us after, 150 years of metallurgy and thousands of years of mining, I guess, to convince the, $8 or $9 billion dwellers of this planet and, the earthlings that actually, we're okay. As Amanda was saying, we're not dirtier or corrupt or more, less in any way, less cautious than any other industry. I'm not even sure if statistically this is not, I wouldn't be surprised if you actually look at, at statistics, that it's probably actually one of the safer industries if you actually clock employee hours and capital spent and translate it into percentage of the GDP. I'm not sure at all that that this is even the most the most hazardous or most dangerous type of industrial or commercial activity. So somehow we put ourselves in the spotlight, and I think it's the job of all of us to fix it.
Do you think it makes an impact to the mining industry overall to have investors maybe that have these ESG requirements in order to kind of get involved with any companies?
So we run what we call a sustainable resources fund. So we have a heavier bias on ESG, and my experience is that the investment community is very aware of ESG, but they don't understand and can't understand, because unless you're a mining specialist, you can't really understand how ESG is complicated. Like it's not, and greenwashing has turned ESG into like a box ticking exercise. And that really doesn't work. Sustainability is about a very holistic approach to how you operate businesses. And I think that investors they're very skeptical about companies that say, "Oh, I'm green, I'm ESG compliant." I think, like all of these things, it's a show me story. Do it right and give an example. Be extremely transparent about it, and you have to show them how it's done. I don't think that you can't specifically. Every project is different. Every project's ESG requirements and optimal sustainable development path is highly customized. The point is, are you going to take the time and figure out how to do it, what that sustainable development plan looks like? And are you going to implement it, monitor it, and report on it? There's an old expression, if it's measured, it's managed. And I think that's where ESG is going to. They're measuring. They're measuring where we want to go. People are expecting us to not just say we check all the boxes, but we measure it and we transparently report on the sustainability of our projects. Absolutely. At least that's where I see it going.
Okay. So earlier we were talking a little bit about how China had kind of long been leading the way in terms of this focus on the energy transition and getting the right metals and securing their supply chains. What we saw during the pandemic was kind of this new focus on more regional and domestic supply chains. What kind of role do you see for governments and other types of regulators playing to kind of push domestic mining and investment and kind of the broader supply chain domestically? Is it the role of like the governments to kind of maintain this push? What role do investors play?
It just depends on who you want to control the industry.
Sure.
Like if you believe it's important for the West to have operating mines, then probably you're going to have Canada or the US step in. But if you think that it's going to be the free market that dictates it, I don't see how you're going to compete with the cost of capital out of Asia anytime soon. So it's actually a fundamental question around how you see controlling these industries. And my view is we're in a decade now of deglobalization and reindustrialization of America in particular, but also the West in general. And so you will see different forms of financing emerge, which are not necessarily market linked, in order to build mines in Utah and Colorado and these places. Otherwise, it just isn't happening. We can talk about ESG, we can talk about all these things, and none of it matters because, I don't foresee that hedge funds are going to rush in. And so the only way is if there's government intervention. And I do think that happens over the next decade as you see a deglobalization, a decoupling, kind of in contrast to the past decade. And you see a reindustrialization of these countries who want to control their supply chains. And this is all a result of COVID, in my view, not the Industrial Revolution.
I would ask
you go first. That's good.
Sorry,
I
Amanda?
was going to say I completely
No, go first, Amanda. I'll go after you.
So all of these new government policies, like I think it's the Inflation Reduction Act.
Right.
it makes reference to both critical mineral supply being important and how important supply chains are and helping to finance supply chains. But I haven't seen any sort of proof of what that's going to look like. The truth is, you need a lot of infrastructure to make supply chains work, a huge amount of infrastructure. And infrastructure is where public and private meet. And infrastructure takes decades to put in. And infrastructure, and industrial infrastructure, has been ignored in the West for decades. China started building up the industrial infrastructure for this 20 years ago. And there's a real harmony between state companies and private companies and the state in China. We don't have that system here. I doubt it'll look exactly like what China's does, but unless the state gets involved and we understand that supply chains are systems that have a huge amount of private and public infrastructure involved in them, I don't see how we could possibly ever truly compete with China.
A few observations on that. First of all, I think that, although we're not necessarily preaching for a command economy or being, extremely red, it is very clear that, just acting as sort of a board of directors, which is the sort of the Western approach, I guess, of governance, is probably not going to be enough here. We need to identify the various bottlenecks which the invisible arm is not able to unclog on its own. Anthony was alluding to cost of capital for these projects. There is a bit of a plan for for DOE loans now. That there are a couple of billions that are allocated to that, and there's actually a few of the advanced development stage lithium companies that have applied and are looking to hopefully be approved in the next few months in the U.S. But that's a drop in the ocean if you actually look at the huge materials gap that we have here. But we do want the government to, as you were saying, on infrastructure level, to as much as possible support, if we're talking about e-mobility and ultimately mobility as a service. A few years ago we were talking about shared electric and autonomous. The electric is only a third of that story. A lot of that has to be with enabling and with technology and with licensing. So we definitely need to have to support infrastructure for charging. We need to support infrastructure for transmission, because if we're going to electrify, the transmission lines that were built during the New Deal are probably not going to be enough in the in the U.S. And potentially, as one of the things that we do see in these type of supply chains, that the midstream, the conversion, is a big bottleneck that's sort of kind of pressing down and holding a glass ceiling over the upstream. But if you take lithium as example, if we had a few, lithium hydroxide / carbonate conversion plants with a capacity of anywhere between 50 and 100,000 LCE per annum, that were able to become the place where the upstream, where the miners and the concentrators would send their product to be further converted, and they would not be under pressure to be fully integrated, sort of mine to hydroxide, let's say, which is not always suitable if you have a smaller resource, if it's a lower grade. But still, it's a little bit like in agriculture. You have processing plants, you have a winery, suddenly everyone grows grapes. So potentially we could even think about a lithium conversion plant or a graphite conversion plant, which is a state-owned enterprise. You get it up and running, then you list it, you're already down to 65, 70%. You gradually divest into the market, and at some point you have an international tender and you sell the control, and it becomes a sort of a retail, someone will buy the control, and it becomes a public company that's up and running and is providing services to potential 5 to 10 mines in that region. And as part of domesticating our supply chains, maybe this is something that we should consider, which is not unlike what has been done in China. Although over there, they stay as sort of hybrid state/private enterprises, and even after they list for other reasons. But we have to be creative. We have to find ways to unclog as many of these bottlenecks as possible, so that wherever there's a segment that the private sector can actually fund and develop on its own, if it's properly motivated, it can fit in. But at the moment, we do have a lot of fragmentation, and actually, I'll come to a story about Anthony, and which is kind of nostalgic and funny, because we're talking about the sort of supply-demand gap, and how, there's so many gigafactories and cell manufacturers announced, but so little, even if you sum up the sigma of all the planned and maybes, there's a huge gap in terms of providing material that will actually go into all these machines and ESS batteries and so on. And Anthony, I don't know if you remember that, but in 2016, you were very bullish on cobalt. And we were sipping our Diet Cokes and kind of chatting and about what later became the company that you founded, Cobalt 27. And one of the things we were doing, we were trying to multiply the number of cars. We said, okay, there's about 100 million cars sold every year, passenger cars. Let's assume they'll all be electric. Each one has a few kgs of cobalt in the battery. We started doing the numbers. It became humongous. And I said, look, but it's a new technology. It was 2015 or 16. There were very few, BEV cars out there. The world was still licking the wounds of the collapse of Better Place, the company that Shai Agassi from SAP and Renault started a few years before, and was supposed to be the crown jewel of e-mobility. You would go into a station, you'd replace your empty battery with a new battery and keep going. And so we were talking about that, and I said, look, Anthony, you have to, I kind of gave him the marketing 101 thing, the MBA stuff. You're going to have the early adopters, but then you're going to have a huge chasm, and who knows if it's really going to pick up, and what's the angle going to be of the slope of adoption. And then Anthony got a call on his cell phone, on his smartphone, and he kind of answered. And then he was looking at his phone, and he looks at me and says, yes, Eris, but what if it turns out to be like what happens with the smartphones? Look around us. They've been around for, 3-4 years? Everyone has a smartphone. You don't even see any regular phones anymore. What if the EVs are going to be like smartphones? And I think we're pretty close to that moment. I'm in Israel now, visiting my parents, and I was just watching the news, the afternoon news on TV. Adoption rates this year are 7.5%, up from 2% last year, and the most popular car this month was a Geely, an SUV. So and I'm sure it's the same about a lot of other sort of Western countries. So I think we've reached a point where everyone wants a smartphone. Everyone that if you ask people, would you buy an electric car? I think no hurdles for adoption at the moment, other than price. It's still, sadly, in many places, kind of a rich man's toy, and not something that's affordable and and can really proliferate all the way down. But we'll get there. No, anxiety, range anxiety. I think it's pretty much over. At least if you're not living in any rural area or anything like that. The brands, the looks, the feel, everything. I think that pretty much anyone that's thinking about buying a new car next year, if you ask them, would you buy an electric? Sure, why not? If there's any, if there are any reasons not to do it, it probably has to do with, is there a charging station? What will, practical aspects, but trust in the brands, in the technology, in the future of electric cars, being the dominant technology, I think is absolutely there. We've reached a point where, in theory, if we could start producing only electric cars, we wouldn't have any marketing issues whatsoever, even without the cash rebates and all the the demand side type of support that we're getting. Yeah, so if the support
right.
should be to the supply side, not to the demand side anymore.
I think you're sort of half right, but potentially there's a few issues with that argument. I totally agree with you that it's like smartphones. I think anyone who's buying a new car would have
with Anthony, not with me. You're
would
agreeing with
happily buy.
2016, Anthony.
Well, I agree with 2016. I agree with you in 2022. I think anyone who could buy an EV today would buy one, but the truth is you can't. There's like a year-long, in most places,
Of
there's a
course.
year-long wait for an e-vehicle. And they're going up way more than inflation in terms of cost,
Yeah,
because we
yeah.
simply don't, it's not like smartphones. We had enough metal to
do
make
with smartphones.
smartphones. We
totally
don't
agree
have
with
enough
you.
metal for the whole world to be driving NMC electric vehicles. I think that
Amanda, I totally
we're going to
agree
need
with
some
you.
alternatives. We're
I
going to need
totally
some
agree with you.
alternatives to the existing technology if we want
Mm.
everyone to go green, or because we neither have the metal nor the money right now.
Mm.
And
I
so I
agree with
think we're
you.
going to have to get creative with technology if we want the
I
world
totally
to
agree with you.
truly meet the goals of the energy transition.
I totally agree
I'm
with
getting
you.
a bit
And
conscious of our timing.
time, yeah. No, but it's a great
I think a good
segue
way
to technology.
a good
Yeah.
a good way to
So-
kind of wrap things up is, this idea everyone wants an EV. Can we get, that we don't have enough metals to go into it? What's the way forward? What's the solution? Or I don't, solution might be a broad term, but what do you see as we, as the energy transition is accelerating, and it needs to accelerate, and investment needs to go into this space? I guess maybe just looking at kind of your predictions or what you would like to see happening in this space moving forward.
Maybe I'll go first because I want to agree with Amanda that there's not one solution. It's sort of like it's a Kaizen approach. You do a lot of small things and incremental things, and every now and then you have a leapfrog that kind of pushes you a lot forward. But it's an effort. So first of all, LFP is back, which is something that will already take some of the pressure away from NMC. And for swarms of urban vehicles, fleets that will kind of do the last 5-10 miles, LFP is fantastic. It's it's safer, it's cheaper, no issues whatsoever. So that's part of that. For the heavy lifting, we'll probably have hydrogen fuel cells. Within all these technologies, there's a lot of incremental improvement, which allows you, if you have, for example, better coating of the active materials of the NMC or the LFP, and there's the niobium tungstite approach now that will allow for faster charging, for higher energy intensity, etc. There's a lot of smart people out there that are moving this technology forward, making it more efficient, hopefully more cheaper, cost effective. Between those various technologies, I think there's space. Over time, we will have more recycling, so some of the materials will come back, and to some extent, at least offset the need for new materials. So that's another approach. Obviously, it's going to take time before it's meaningful, but it's getting there. It's consistent, and it's going hand in hand with primary. It's not just an afterthought 50 years later. Well, let's recycle all that stuff that accumulated. It's something that's happening sort of in tandem with primary. So I think that's a good thing. In general, I think that technology is a big key to pretty much helping with everything here, including, by the way, with exploration. Exploration is time consuming, is costly, and a lot of it has to do with lack of accuracy, with raising another $1 million to drill another few holes next summer, and so on and so forth. There are probably better ways of doing it. We have mass data, we have AI, we have satellites, hundreds of satellites floating up there that can identify, a silo in somewhere in Siberia or in Dakota, depending which side you're on, and identify exactly what's there. These type of technologies can probably help us a lot with improving our exploration and pushing more metals and more projects forward quickly into the yes no kind of or yes maybe decision point, and of course technology and improving the processes, improving everything that has to do with the efficiency of making the cells, and if it's in renewable energy, pretty much the same thing. And as much as possible, creating sort of hybrid solutions, like we were talking about connecting renewables and mining. It also works the other way around. So we see that, in geothermal power production, you can probably also filter the water and capture lithium and potentially other materials there. So I guess there is no answer. It's an approach. It's just like DLE, direct lithium extraction, right? It's not a single technology. It's an approach. Let's try and replace ponds with some sort of a filtration or an ion exchange, quickly capture the material and send the water back down. So same thing about, how do we resolve this huge gap between the adoption and the demand and the supply? It's going to have to be a little bit of everything, and potentially adoption will have to be slower than we envisioned, than we want it to be. It may just take more time. And in the meantime, hopefully, and this is something we haven't touched on, but the risks of fossil fuels and coal, and a lot of them being kind of owned by people that live in problematic zip codes. Nuclear is probably going to be our baseload for this century. And I think ditching it post Fukushima was a big mistake, and hopefully we can go back to that. So the way I see things, the 21st century is the century of sort of a nuclear baseload with renewables sitting on top. And hopefully in the next, as things move forward, maybe nuclear will become, fusion instead of fission. There's a lot of things that can happen to improve that as well. But it's an approach. There's no one single solution, but we cannot continue the way we are at the moment. And just watch the news from Pakistan from last week, and the examples are abundant. We're sitting on a time bomb here, and we better start moving.
I actually have I completely agree with everything Aris said, and I think he's been he covered the gamut. It's about a lot of different technology and approaches, and changing the way we look at energy. And it's going to be slow. It's not going to go as fast as anyone hopes.
No.
But we'll get there together. And with a little bit of practical and innovation, we will get there. It's just not going to look exactly the way everyone thinks it will.
No.
Very interesting. Yeah, no, that's really interesting. And I think that leaves us on kind of a nice positive note, to move forward and keep having these discussions. So we've lost Anthony, but I'd like to thank you guys for taking part today.
Thank you very much.
Thank you
very
too.
much. Thank you, Amy. Thank you,
All right.
Amanda. Thank you, Anthony.